my career right out of college. And the first gig I had in college, after I graduated college, was in the mortgage industry. I had a buddy that was a year ahead of me. He had already started in the mortgage industry, and this was back in 2000, right? So in the quote unquote heyday of the mortgage world, the subprime world, right? And he told me, he said, look, I'm at this gig and it's really good money, and I think you could do really good at it. And I said, well, what is it? He said, it's mortgages. I said, I don't know anything about mortgages. I'm renting right now. I'm a poor college kid. There's nothing. I don't know how I would land a job because there's nothing I know about it. And he said, well, let me show you this sheet of the top performers this month. And it was fellas making $40,000, $50,000, $60,000 a month. And I was like, I'll figure it out. So I said, you get me an interview and I'll make sure I land that job. So he got me the interview, and the only thing I could think of to land the job, because again, I didn't know anything. In college, I was studying finance and marketing and economics, but mortgage just wasn't my world. And I said, well, what I'll do is I will make a claim so strong that it's going to force them to hire me. And that's what I did. So I was interviewing with the senior vice president, and I said, who's your top performer here? And he said, well, it's so-and-so. I said, okay, well, what are their numbers? And he told me. I said, well, I promise you this. If you hire me, I will double her numbers in my first year. And I said, and that's a guarantee. He's like, whoa, okay, well, that's pretty ballsy. And again, this didn't come from confidence. It wasn't like I actually thought I was going to do this. I just wanted to land the gig and get the job. So I did. He hired me. That was in January of 2000. Fast forward to October of 2000. And we're all in what's called a bullpen. There's 100 of us loan officers sitting in here, and the senior vice president will go around throwing objection out. And finally he comes to me and he throws an objection out. I do my best to overcome it. And he felt like I did a really good job overcoming it. So he took the moment to say, hey, he interviewed almost a year ago, and this is what he said. And Michael, I don't know if you're aware of it, but we have this award of the top performer for the year that we will announce after December. But you're so far ahead, nobody's going to catch you. So we're going to go ahead and tell you that you're this year's winner. And I was just as shocked as anybody else because I wasn't paying attention. I just had my head down trying to figure out this mortgage gig. So I was good at it, but it was something that really opened my eyes to how the banking and lending world really works. And it's not what mainstream media or what even your friends, family, and even some of your mentors are telling you about. It's the complete opposite. In the mortgage world, it's big paychecks, it's big commissions. If I were to do a mortgage today, let's say it's a $400,000 mortgage, I can make $8,000 on it. But if I did a $400,000 home equity line of credit, this is how much you make: $0. So at times we need to think about, or be that 5-year-old. What's the favorite question a 5-year-old asks? Why? I've got a 6-year-old now, and it's every single day, 100 times a day. Why? And that's what I was. Why is it that mortgages have such huge commissions where HELOCs don't? Well, it's because mortgages have huge profits. Where do profits come from? Profits come from consumers overspending. Well, if HELOCs don't have huge commissions and don't have huge profits, well, isn't that something that I should probably be consuming as opposed to the mortgage? And in the long, the answer is yes. That is exactly what you should be consuming, and you should not be consuming a mortgage for the right people. This isn't for everybody. I've got a buddy in the banking industry that's got a famous quote that this is like yoga pants. Everybody can wear them, but not everybody should. And that's the way this is you have to have your finances in order. And obviously, if you're a part of Jerry's audience, you're already financially savvy to a certain degree. You probably have already mastered your budget. So that's really who I'm speaking to. If you're just trying to get that in order and you're spending everything that's coming in, this isn't going to work for you. But for those that are budget friendly, this is the only way that you should finance real estate. So I had a mentor that company was publicly traded. We were the 9th largest lender, and it was on my birthday in 2007. So I had a short stint in the subprime industry for 7 years. And then that company filed bankruptcy. So everybody knows the real estate meltdown, the subprime industry just didn't exist. So it was on my birthday in 2007 that they filed bankruptcy, let everybody go. So I took 8 months. I came back home to the family farm and was doing my thing there. And then finally that same company called me back and said, look, we're resurrecting. And what they did is they got capital from a hedge fund. So the hedge fund was out of Connecticut. I was in Nashville at this time instead of in Charlotte, North Carolina. And the hedge fund manager's parents lived in Nashville. So from time to time, he would fly into Nashville to, one, check up on his parents, but two, to check up on his money. I was director of operations now for this company instead of just a loan officer and managing some of their branches. So he would come into my office and mentor me and check up on his money. And it was after a couple of visits, I took the opportunity to try to get in his sphere of influence. At the time, he was worth several hundred millions of dollars. Now he's a billionaire. So I'm like, look, I need to know what this guy knows and get in his sphere of influence, because birds of a feather, right? So hopefully some of that would rub off on me. And so I took the opportunity. I said, listen, this company owes you 25 million bucks. The quickest way to get it back is we do a lot of volume. So folks like you, if you're doing mortgages and not paying cash, then you're probably doing big mortgages. Big mortgages are big paychecks. So if you could get me in your sphere of influence and introduce me to those folks, then I can do those transactions and you can get your money back a lot faster. And he said, sorry, we don't do mortgages. And I said, that's what I thought. You probably pay cash. And he said, no, we still use other people's money. He said, but what we primarily use is simple interest lines of credit. He didn't come out and say home equity line of credit. That's where I put two and two together. He just said simple interest lines of credit. Because when you have that kind of money, you can go get simple interest lines of credit from all different sources. It doesn't have to be on a home. It can be on a business. It can be a margin account, et cetera. So he explained to me why that was more advantageous than a mortgage. And then he left me with a quote that will always stick with me. He said, Michael, you're basically a dope dealer, because what you're doing with mortgages is you are selling financial crack to middle America. And he specified middle. So I wanted to dissect that. Like, why is it middle America? Why do you say that this is financial crack to middle America? He said, because the top 1%, primarily, they're not doing mortgages. He said, but the bottom lower percent, they don't qualify. So really all you're doing is you're selling financial crack to the middle piece. And so again, I'm a dope dealer. That didn't sit right with me. And my whole career up until this point was in the mortgage industry. And I thought I was, helping people out. And to a certain degree I was, cash out refinances, helping their credit, lowering their payments, reducing their term, getting them paid off quicker, but not to the degree that I am today. So I actually fought this for a year and a half, hired a CPA actuary, and then now my business partner, Matt, he was one of the first calls that I made, because he was somebody that was managing multi-billion-dollar funds for Wells Fargo. And I said, if anybody can help me poke holes in this, you're the guy for the job. And for a year and a half, we tried to figure out every angle to poke a hole in this, and we couldn't. So the more I tried to prove him wrong, I actually proved him right. And it was in 2012, I took the leap of faith and said, this is what I'm doing with my own personal finances. I wasn't telling anybody about this, but this is what I did with my own personal finances. And it was funny conversation I had with my wife. My wife was like, you're crazy. I needed to get her consent to make sure she was okay with doing this. I said, but I'm going to turn everything that we owe on this house into a variable rate home equity line of credit. And she's like, my gut tells me that's not going to work out. But she's like, fine, this is what you do for a living. I trust you. Let's go with it. In 3 years, we paid off that house. Now, I was in the mortgage industry, so I was probably making more than the average American, but it wasn't gangster money. It wasn't like I was making $400,000, $500,000, $600,000 a year. I was around $200,000 a year, and I, had kids and other bills too. So it wasn't like I was killing it from an income standpoint, but I was able to pay the home off in 3 years, because this is just a far more efficient way of financing real estate. And then it was in 2014, I had another mentor, a marketing mentor, that was interviewing me for, I think the magazine was like Mortgage Success or something of that nature. And so he's just interviewing me saying, hey, you make a career out of growing branches and helping companies scale. So we're going over that for 45 minutes. And then the last question was the one that really catapulted my career. He said, what is the one thing in the mortgage industry that nobody's talking about and nobody really knows about? And he said, it's the mortgage industry. So maybe there's nothing new under the sun. Keep in mind, this is post 2008. So you've got Dodd-Frank bill. So FHA is an FHA, a VA loan is a VA loan, USDA Fannie, Freddie, it's all government controlled. So every lender in the country has the exact same products. He said, so there may be nothing new, but is there anything that you personally do that would be different than what you've talked about today? And obviously this is shooting myself in the foot. So I shouldn't be putting this out there for the masses, because what I do is I offer mortgages, but yet I'm going to sit here and expel a secret that I don't personally consume mortgages. I actually consume a home equity line of credit. That would be shooting myself in the foot. But I just said, you know what, whatever, I need to tell the truth. So I did. And it was after that interview, he called me back and he said, for the first 45 minutes, there was no passion. He's like, dude, this was very vanilla. This was boring material. I hate to say that. He said, but the last 15 minutes, your energy level went through the roof. He said, I could tell you're totally passionate about that. That's what you do. And it's also something I've never heard of before. You need to create a business around that. And I said, what does that look like? HELOCs don't pay anything. There's no commissions in it. How could I build a business around home equity lines of credit? That's what he said, there's so many people out there that don't even know that it exists in this strategy and why it's good for them. So you need to put together a course to teach people how to do this. And I was very skeptical, but I was like, whatever. So I flew down to Boca Raton, spent a week building a course with him. And it was within 90 days, we were making more money educating people on what I was passionate about than I was making in the mortgage industry. And that's when I looked to my wife and said, honey, I'm done with the mortgage industry. So since 2014, I haven't touched a mortgage since. And we've been on this wonderful ride with Replace Your Mortgage, now Replace Your University, for 9 years. And we have taught well over 8,000 people. And we have one of my favorite numbers is we have a 98% success rate. So when we bring people on as a client, we've got a 98% chance that you're going to be successful in what it is that we teach. So I'm super proud about that. But yeah, that's my backstory. Sorry it took so long, probably 15 minutes to explain that. But I think it's important to give some people some context that, I'm not a marketing guru. I'm not somebody that's trying to sell you a widget. I'm a former mortgage guy for 17 years, and I'm telling you something that I did not want to be true. And I think it's important for folks to understand that.
Yeah, I love that, Michael. And that relates a lot to kind of my backstory, as being a financial advisor, learning about, we call it the sacred account, the infinite banking concept using whole life insurance. But guys, we're going to dive into a lot of material. So before we jump into some of the main meat and potatoes of like, what is Replace Your Mortgage? How does it work? Some of the questions you guys have. I do want to just do a couple of quick announcements. So first thing is, if you have any questions, drop those in the chat. You guys know I like to mic up and go live. It feels like kind of a talk show environment when we do that. I like to keep that communication flowing. So if you guys have questions, drop those for sure. Michael and I can answer them. Joe on my team is also going to be reaching out in the chat if you've got questions, if you'd like to learn more about Replace Your Mortgage. And then we do have a QR code, and I'll pop this up a couple of different times throughout tonight. So if at any point, you're watching or listening and you're like, this makes sense, I would like to schedule a time and learn more, you can go to rym.wealthdynamics.com. There's a little questionnaire to fill out. You'll be able to schedule a free appointment with the Replace Your Mortgage team and learn more about this concept. You can also use the QR code with your phone. And working with them is a lot like working with us, where it's very educational and it's a strategy. Right. You're going to learn tonight, like the first position home equity line of credit. Yeah, you could go to any bank in the world and go ask for one. It's what's the system, the strategy, the education, and making sure it's done correctly. Just like with the sacred account, you can go to any insurance guy in the world and say, hey, sell me whole life insurance. It doesn't mean it's going to be the right product. It doesn't mean they're going to know how to help you implement the strategy. Right. So as you're listening tonight, I want you really thinking about, okay, what's my purpose for being here? How do I plan to apply this? And then what are my questions? Because this is very similar to the life insurance thing we teach. It's very similar to the banking thing we teach. We're going to be maybe getting rid of some preconceived notions, some limiting beliefs, some fixed ideas on how to finance a home, how to own a home, how to invest in real estate. And so you want to be open-minded, but also if you've got questions, if you've got, objections, let's definitely discuss those tonight too. So that's what I wanted to start with as we're kind of going through things. And it looks like Michael's getting some notes going already. But
yeah, I can't help myself.
Awesome. First thing I want to start with, is just kind of what is the HELOC versus the mortgage. And it looks like Michael's going to jump into that with us first.
Yeah, so one of the most powerful aspects of a home equity line of credit versus a mortgage is a closed-end product, right? And where this started from, a mortgage wasn't always a closed-end product. Prior to 1913, I think it's important for you to also have a bit of a history lesson. So what I'm going to teach you tonight is not something new. It's actually going back to basics. It's what we used to do in this country prior to 1913. So pop quiz real quick. In 1913, can anyone guess what happened in 1913? It kind of changed the landscape of banking forever in this country. IRS. No, that's a good answer though.
That's one of them. There's another one.
There we go. There we go. Good job, Avery.
The
The Federal Reserve. So in 1913, the Federal Reserve was created, and obviously, I'm talking to a very astute audience. One of the best books to read up on this topic is The Creature of Jekyll Island. And a lot of people, when I tell the story, they think it's a conspiracy theory. No, this is a biography. This is a historical documented event of what happened. Was J.P. Morgan, which came out of the House of the Rothschilds, was basically planted here in the United States to create a central bank for the United States. And, we know it today as J.P. Morgan Chase, but he was a very wealthy banker. And he was instructed to create a central bank. So they had a private meeting in 1911 off the coast of Georgia called Jekyll Island. So he owned that island, very secretive meeting, had some politicians there and some other wealthy bankers. In fact, the 6 people that were in that meeting, their total wealth comprised of 1/4 of the world's GDP. That's how wealthy they were. So in that meeting, what they devised was the plan of the Federal Reserve. And what the Federal Reserve does is, one, it's neither federal nor is it a reserve. It is a backstop for banks. It allows banks to execute a really cool magic trick called fractional reserve lending. So in full disclosure, I actually sit on the board of a bank. I own a joint venture with a bank too. So yes, I do it because I need to create consumer-friendly products that are also bank-friendly. But yes, banking is just one of the oldest forms of making money, and it will always make money. So I can tell you from personal experience, what banks focus on is core deposits. Now, how do they do that with fractional reserve lending? Fractional reserve lending is for every dollar you put in a checking and savings account, money market, CD, they have the ability to lend out $10. Now, in some situations, whether it's a credit union, it could be 15 to 1. So think of it this way. Picture me giving you a dollar bill and you snap your fingers and you turn that dollar bill into a $10 bill. Who's on the $10 bill? Is that Andrew Jackson? No, that's the 20. It doesn't matter. Well, whoever's on the $10 bill. So you turn a George Washington into the other president. $10 bill. That's a very powerful magic trick. But now what are you thinking to yourself? You're like, all right, Michael, you've got dollar bills. Any chance you got a Benjamin on you? Because if all you got to do is snap your fingers and you turn 100 into a 1,000, that is a very powerful magic trick. And that's basically what banks are able to do with fractional reserve lending because of the institution of the Federal Reserve. So banks got together. Well, I'm kind of getting ahead of myself. Prior to that, a mortgage was very similar to a home equity line of credit. Money could move in and out freely. It was especially popular with farmers. So if I owned a $200,000 farm and owed $100,000 on it, and I needed to buy farm equipment, I could go down to the bank today and say, I need $10,000 to buy a farm, or not buy a farm, but buy farm equipment. And then when I sell my crop, I'm going to, put that in there. So money could move in and out of a mortgage freely. It acted just like a HELOC prior to 1913. So in that transaction, let's say you got $10,000 for the farm equipment, but then you sold your crop and had $20,000, you went from 110 down to 90. And that's where a lot of Americans, especially farmers, were storing their cash, was inside of their real estate because it was liquid. It wasn't under the mattress, and it certainly wasn't in the banks because they didn't trust the banks, right? And somehow we've lost that, and now we trust banks almost too much. So it was a two-way street. Money could move in and out freely. That's why they were far more efficient. Now, you'll hear stories of, well, back in my day, we buy a house, we paid it off in 10 years. Yes, I will agree it was a better generation. They didn't have social media and all the distractions and TV that we have today. They read books and educated themselves versus stupefying themselves. But they also had better financial tools, which the mortgage back then was entirely different than the mortgage that we see today. So after 1913, all of that changed because the banks got together and said, we need to grow core deposits because of this fractional reserve lending magic trick. We need more people to deposit money into our coffers. So how do we do that? And they made one simple change. They made a mortgage a closed-end product, meaning money could go in freely, but it cannot come out freely, like the home equity line of credit. So think about it as an American consumer. What do you do now? Are you going to put 100% of your money into a mortgage that is closed in, or are you only going to put some of it in there, right? So that's what you're going to do. You're only going to put some of it in there. You may budget and actually pay more, but you're not going to put all of it in there, because if you do, it's stuck. It's stuck in the bank's treasure chest. You can't get it back out freely should you need it for gas, groceries, farm equipment, you name it. So think of it again as an average American consumer. Where are you now going to leave that money? You're not going to put it under the mattress. The banks come along and say, hey, we'll hang on to it for you, and we'll even give you a rate of return on your money if you just store it with us. That's why the 30-year modern day mortgage was created. It wasn't created to exacerbate the interest paid on it. That was actually a byproduct. That was the, holy crap, not only do we get core deposits, but now people pay more interest. This is an awesome product. The main reason was to segregate people from their cash so that you only put some of your money towards your mortgage, and then you put the other portion in the safekeeping of the banks. Now let's talk about that rate of return that you're getting. The national average rate of return on a checking account right now is 0.24%. Okay, with inflation still above 6%, you're losing money. You're losing well over 4,000%. Okay, that's a negative 4,000% rate of return. So where does that math come from? If you take a quarter and you put it in and then you lose 5-6%, it's not the margin. So we have to think the difference between an interest rate, the margin is not how much you lost. It's how many times that money did you lose. It's a negative 4,000% rate of return. But if it's a negative 4,000% rate of return for us consumers, then who's it a positive rate of return for? The banks. So it's called turn or yield, right? So we deposit our money into a checking account at 0.24%, only to look to the left and need a loan from the loan officer who's going to give it to us at 5 and 6%. That's how you lose a guaranteed negative 4,000% rate of return. So really what we need to do is go back to basics, and we need to start utilizing instruments like a home equity line of credit or a business line of credit or any simple interest line of credit where money can move in and out freely. And that's essentially what a HELOC does, is it goes back to basics of what a mortgage used to be, is money can move in and out freely. So here's the math on that. And really, before I kind of get into the math, Jerry, is there any questions on that?
Yeah, we have a couple of questions that came up. So let me pop up our chat really quick.
Sure.
We've got a few that came in. Looks like our first question is, and we'll kind of probably dive into this. We have a question on what are the specific aspects of the first lien HELOC. So like Michael said, it really is a two-way loan. You can put money in, you can pull money out, which is very different than, a bank product, like a normal mortgage. But she asked Michael, when talking to a bank lender, what are the qualities or vocabulary used to differentiate the first position HELOC from their other loan products?
Yeah, it's funny because somebody just asked, what is the all-in-one? The all-in-one is actually the most expensive HELOC product in the marketplace today. So what we do, actually, I have a whole team. All we do is investigate banks and credit unions on their equity products, whether it's a home equity line of credit and first lien or second lien, or any simple interest line of credit product that they have that can be collateralized. We have a team that investigates banks, and we've investigated well over 2,000 banks at this point. And out of those 2,000 banks, CMG's all-in-one. I know they have great marketing. And here's the thing. I shouldn't say it's terrible. It's better than a mortgage. Anything's better than a mortgage. But if you wanted to compare it to other banks' equity products, it's the most expensive one. It's also the only one that still charges mortgage insurance. So no other HELOC product that we have found out of 2,000 banks actually charges mortgage insurance. Mortgage insurance is not something that's good for you. Some people will pound their chest like, I'm not worried about this. I pay mortgage insurance. That's not a good thing. Mortgage protection insurance is a little different. Mortgage insurance is totally something that's a waste of dollars for you as the consumer. It does not protect you. It only protects the banks. So the all-in-one product is, I don't want to call it a bad product because anything is better than a mortgage, but when you were to compare it to other home equity lines of credit products, it's sometimes more expensive than a mortgage. And it's definitely, the guidelines are not nearly as attractive as some other community banks and credit unions around the country. So it didn't answer the original question just because I saw one pop up. What was the original question again? Sorry.
Sure. The original question was, and that's actually really quick to piggyback on. That's a good point. So those of you that are old school wealth dynamics clients, we used to actually do the all-in-one mortgage. And so we don't do that anymore because we work with Michael's team instead. And he's completely right. The closing costs are much like a traditional conventional mortgage. The insurance is there, all the things he mentioned. So, you know, one of the things that that we'll go over tonight is the strategy of periodically refinancing as your equity goes up. And that's something that becomes exponentially more advantageous for you working with Replace Your Mortgage versus an all-in-one loan. Just because those additional costs don't keep coming up. Those closing costs are not going to happen every refinance.
Right. And I remember the question too, it was when talking to a banker, you know, what are some of the important questions to ask? One, it's important to talk to the right banker, because most bankers, I want to say something that it's not politically correct, but bankers are stupid, right? More so than loan officers. The reason being is bankers are generalists. So when you talk to a banker at a bank, they are not only working with you to get a home equity line of credit, but a checking account, a savings account, a CD, a money market. Maybe I need to cross sell you over here for a credit card. All things banking, right? When you walk into a bank and talk to a banker. The problem with that is, again, they're not specialists in any one thing. So if you walk into a bank and talk to a banker and say, hey, I'd like a first lien position home equity line of credit to dump all of my to basically treat as an operating account and dump all of my reserves into, and in that way I accelerate the payoff of my home in 5 to 7 years. When you rattle all that off, they're going to look at you like you're an alien, like you have two heads. They don't know what you're talking about, because the first thing you brought up was first lien position home equity line of credit. So a banker, again, who's a generalist as opposed to a loan officer, this is where I will give loan officers credit. They're specialists. Loan officers have to figure out how to get the deal done in order to close, because if they don't get paid. A banker, however, does not care whether you close or not. And I'm kind of generalizing here. I'm only saying from a monetary incentive standpoint. They may be good people and they want to see the best for you and really want you to close, but they don't feel it in their pocketbook if you don't close, because they don't get paid anything on a home equity line of credit. So they don't really specialize on troubleshooting what it is you're trying to accomplish, whether it be the right product or not. And you got to be careful with bankers, because if you don't ask the right questions, they will give you exactly what you asked for, right? So you got to ask powerful questions. And it doesn't always have to be a HELOC in first lien position. I'm a big proponent of that. I think that's the holy grail, especially in this market economy right now, where interest rates are skyrocketing. And, you know, it's kind of counterintuitive. You think, why in the world would I take my 3% mortgage and put it on a HELOC that's a variable rate when interest rates have skyrocketed over the last year? The reason being is banks are flooding the market with what we call promo rates or introductory offers. So that's another thing that my team does. We scour the market to find out in every single state what banks are offering the best deal. Like, for instance, today we helped somebody get a 2.99% 24-month locked rate in Florida. You know, we've got a 5-year fixed at 3.75 in California. So the reason why banks are flooding the market with these types of offers is for two reasons. Banks still need business coming in the door. They still need new customers. They still need new originations. The biggest reason is a lot of folks that don't know how to utilize a home equity line of credit the right way got their HELOC 2-3 years ago at 2.5%, 3%. And now they're sitting at 8-9% because they never paid it down. And what happened to their payment? Their payment has now tripled. So banks are flooding the market with these types of offers because they're trying to protect their balance sheet. That's another thing that's different about a HELOC than a mortgage. A mortgage originated by the lender, sold off at the closing table. They don't have to worry about it. A home equity line of credit is that bank's asset. It sits on their balance sheet. So you now have a relationship with that bank until you move on from that home equity line of credit, where it's your lender. You know, say, hey, you know, where's my mortgage at? I don't know. It's with this servicing company over here, or this hedge fund bought it over here 2 years ago. When you get a HELOC from a bank, it's their balance sheet. So that's good and bad. The good part of it is you are now in control of that relationship and you get better terms because you kind of can manage that relationship. The bad side is you manage that relationship, right? So the banks are very protective of their balance sheet. So they're flooding the market with these intro offers to prevent future defaults, okay? Cool thing is now that we're into this for however many years that we've been doing this, and there was one company in 2005 that was doing thousands of these transactions every single month, and hedge funds bought that paper off of that company that was doing it. The default rate on first lien position HELOCs was 115 times lower than folks with a mortgage. So I'll repeat that again. The default rate of folks during the mortgage meltdown was 115 times lower of folks that had a HELOC in first lien position than folks that had a mortgage, meaning they didn't miss a payment. In fact, there are still companies today that are, or hedge funds that are holding the same balance sheet that has not happened. They still don't have any defaults whatsoever. I sit on the board of a bank up in Michigan. And like I said, I own part of a joint venture with them. And our HELOC product pays off 7 times faster than their 15-year mortgage product. So good and bad. It's bad because the bank doesn't have as much yield spread premium to make money on that product, but this bank utilizes it to maintain a relationship with its customers because they become business owners, entrepreneurs. That's what they're in it for. They're not really in it for depositories. They've already mastered that up in their market. So they're in it because this is a sticky product. It's not like a mortgage where you make a transaction, you close on a transaction, you never hear from that person again. This is a product that you're interacting with, if not on a daily basis, at a minimum on a weekly basis. So yeah, a HELOC is something that you can utilize to abandon your checking and savings account. I'm not saying go close them out or anything like that, but instead of putting your money into a checking account, you now utilize your HELOC as the operating account. It's something that you pay your bills out of. Again, money moves in and out freely 24/7. So you're liquid. Don't worry about, all right, I make $10,000 a month and I put $10,000 in my HELOC. What happens when I got to pay the cell phone bill? Not a problem, because all of these HELOCs come with online bill pay, sweep accounts sometimes, credit cards that are associated with them. Sometimes the banks will term it a debit card. It's incorrect. It's not technically a debit card, nor do you want it to be a debit card. It's technically a credit card associated with the HELOC. So you have ATM capabilities, and again, online bill pay. So you can pay those bills as you need it out of the home equity line of credit. And in fact, in our course, we teach advanced strategies where we utilize offset accounts to pay our bills, because if we know that putting money into a HELOC suppresses the balance, which then suppresses the amount of interest you pay, then we don't want to take money out of it to pay our bills, because what does that do? It inflates the balance, right? So I'll kind of go through a quick demonstration of what that looks like. And again, because we're low tech tonight instead of tomorrow, can you see this, or do I need to blow it up some more?
Yeah, blow it up if you can.
All right, and for those that want to play along and you can't quite see this, you can go to replaceyouruniversity.com, and at the top, you click on calculators, and it's a HELOC calculator, and you can plug in the exact same numbers. You can play along, right, as you're watching this. But what I have here, and this is a HELOC calculator, current balance, 250 grand. Now, let's be devil's advocate here. And let's say that you're getting a HELOC that is not at its peak, but it's also not a 2.99 or a 1.99. Me personally, I've had a 1.99% home equity line of credit for the last 3 years running. And I do what's called promo rate stacking. So I haven't had higher than 2%. Even today, when rates are 7, 8%, I'm still at 1.99%. But oh, there you go. I appreciate it, Jerry.
Yeah, I'll pull it up on mine here.
Yeah. So if you could type
interest
into
rate?
Interest rate 6%. Let's just play devil's advocate and use a high interest rate.
Good.
All right, rate change per year, let's say 0 for now. We'll come back to that and play with it, just so I can show people what the difference if rates go up or down. Now keep in mind, not all HELOCs are variable. Some are fixed, some are hybrid, right? Most HELOCs are variable. That's why you hear people say, no, don't get that, it's variable. The good thing about, there's a good and bad about variable. Variable means rates can go up, but it also means rates can go down. right? So folks that had a HELOC in 2018 and kept it through the pandemic, what do you think happened to them? Their rates plummeted, hit rock bottom, right? And stayed there for 2.5 years. So variable means not only does it go up, but it can also come down. So let's just say that's 0%. Payoff goal doesn't really matter. Let's just put a number in there and say 180 months. Net monthly income, let's say 11 grand. Household income, just easy numbers. Monthly expenses, 5 grand. Now here's the key with this column here, monthly expenses. You do not put your mortgage payment in here. Why? Because the HELOC took care of it. It paid it off. So don't allocate for that, and don't continue to pay your mortgage lender when you don't owe them a penny, right? So we're not going to put the mortgage balance or the mortgage payment in monthly expenses. And you also don't put the payment for the HELOC in there. It's on the back end. I'll show you on the report here in a second. Annual fee, let's put $35 in there. That's typical. All right. Now let's hit calculate. And let's look at the graph below. How many months does it say it's getting paid off?
Looks like 37 months.
37 months. Let's see if I got the same thing. You mean 47 months? Did you say 37?
Mine says 37. You did 200,000 balance?
No, 250.
250. That's our difference. Okay.
Okay. Yep. So 47 months. So this means you've got a $250,000 balance on your HELOC. You've got 11 grand going in. You've got 5 grand coming out, and you've got an annual fee to use the HELOC of $35. It means you're paying it off in 47 months without changing anything about your budget. Now, again, that's at a 6% interest rate, not a 1.99 or 2.99. Now, Jerry, if you could go back to the 0%, and let's change that to 0.5% every single year, which means it's no longer variable. It just means that it's not only not going down, it's always going to go up by 0.5 point every single year into perpetuity. And then hit calculate. See the graph?
Yeah. Is it still?
Now, no, it's 48.
7 months?
No, it's 48. So it moves it by a
41.
month. Yeah. So if it goes up 0.5 point every single year into perpetuity, which, you know, in 4 years, you're looking at now 8%. So let's take this even further, because this is, you know, a limiting belief that most people have when it comes to interest rates is if it's variable, what if it goes up? Well, this is where cash flow positivity is vitally important when it comes to this. That's why I said this is like yoga pants. Some people should wear them and some people shouldn't. So 1%. So it goes up a full point every single year into perpetuity. Now, what does it do?
Uh, 49 months.
49 months. Moved it up another month. All right, let's go. Let's go to Biden's economy. Let's put 2% in here. You like my inside joke? All right, 2% every single year into perpetuity. So the Fed never pauses. The Fed is always increasing interest rates substantially every single year into perpetuity. It's now 50 months. This is what people are scared of. This is the limiting belief that people have, is they think the interest rate dictates how much interest you pay, and that is not necessarily true. The two things that are far more important than interest rate is time and balance. Okay, so I'll give you another pop quiz. 30-year mortgage. You got both of these scenarios are 30-year mortgages. One is that they're both at 300,000, or I'm sorry, one is at 300,000 at 3%, and then you have a 200,000 at 4%. Both are 30-year mortgages. So we're talking about balance here, right? So one is at 300 grand at 3%, another one's at 200 grand at 4%. Both 30-year terms. Which one do you think you pay more interest on? The 3% or the 4%? Yeah, most people would say that you're going to pay more interest on the 4%. That's incorrect. You're actually going to pay more interest on the lower rate because balance is far more important than the interest rate. Now, let's look at time. Let's say you have a 30-year term, both the exact same balance, 30-year term at 3%, 15-year term at 5%. Now, obviously, you get a discounting rate for having a lower term, but let's just say you didn't, it's 5%. Are you going to pay more interest on the lower rate, or are you going to pay more interest on the higher rate? And we already know what direction this is going in.
Yeah.
You're going to pay more interest on the lower rate than you are the higher rate, because time is more important. Those are two things that are far more important when financing anything, including real estate, is focusing on time and balance, not the interest rate. Interest rate dictates your payment. It does not necessarily dictate how much interest you pay. So that's essentially what we're doing with this calculator here is, again, you also have to change where your cash goes. So you can no longer have segregation of income. Since the HELOC is an open-end product, money can move in and out freely, and you can use it just like a checking account. Everything should be focused towards your home equity line of credit, and then you pay your bills out of it, including your investments. So look at it this way, because I know we're talking to people that are big fans. I am too, of IBC or Sacred Account. First and foremost, this is a place to park cash. So it's working for you even when you sleep. Then it's there should you want to then leverage it to put into other places like a Sacred Account, which I'm a huge fan of. All right, any questions so far? Anybody miss the math on that?
All right, looks like we're tracking with the math. We've got some questions on credit and debt to income ratio. What role does that play, and where should someone be at to do a HELOC with credit and income?
Good question. Good question. All right, so where did I go? Let me go to my canvas here. All right, so when it comes to credit, ideally you want to be above a 660 credit score. So it doesn't have to be perfect, but it needs to be decent. So a 660 credit score or above. The other thing is you want to have 10% equity in your home. Now, I will say this with a caveat. Technically, you don't have to have 10%. We have found quite a few community banks and credit unions that do 100% financing. I wouldn't, if I, sat on the board of that bank, I would not advise it, but they do. We actually found one in Utah that was doing 125% financing.
Wow.
Because of the real estate in Utah, it totally makes sense, because think about folks that took advantage of that 3 years ago and what real estate did. They're now sitting at probably a 90 to 85% LTV because of what real estate did. They just got free equity because of the appreciation. So it lucked out for that bank, but 10% equity. Now, here's the hardest thing for a banker to understand is if I have 10% equity, how am I going to take 10% to pay off 90% of my balance? It's a simple refinance. That's why we call it replace your mortgage. All you're doing is refinancing your existing mortgage and changing the nature of that debt into a home equity line of credit. See, everybody thinks as a home equity line of credit is a second lien product. It's something you get based on the equity above and beyond your mortgage balance and the value of your home. No one asked the question, can a HELOC be in first lien position, right? So somebody already mentioned the all-in-one. The all-in-one is only a first lien position home equity line of credit. All the other banks, when you ask them for a home equity line of credit, they'll give you a second lien position. And sometimes that may make sense depending on someone's cash flow. So let's say somebody in that example, they had $5,000 of expenses, but they only had $7,000 of income, but they got a mortgage, 2 or 3 years ago at 3%. Well, we may advise them to put it in second lien position, keep that low rate mortgage. Let's get a second lien position promo rate home equity line of credit, and then we can use that to chunk onto the mortgage over time. That's a strategy as well. But what we do is every time we bring on a client, one, we want to vet them to make sure that we hire them, that we only hire clients. We don't accept customers. Two different things, because the client, they're with us for life. So 70% of the people we talk to, we turn them away, because again, the most important number that I'm after is that 98% success rate. So we want to make sure that if they come on board to become a client, they're going to qualify. So we analyze their situation and their cash flow and look at all the different strategies that may make sense for them to effectively use, including my favorite is 0% business lines of credit that you don't even have to have a business to get currently. You can set one up. It's a whole different strategy too. But yeah, you can get hundreds of thousands of dollars of 0% business lines of credit. And I personally use that as an offset account, but you could use that to chunk down onto your HELOC if you wanted to. I've also used it to purchase other businesses like publishing businesses and so forth. So 10% equity. And then here's the key: cash flow positive. So if you're living paycheck to paycheck, you can go ahead and just cut this off. But if you have more money coming in than what's going out, this will work for you, depending on debt load, right? So you can't come to me and say, hey, I got 10 grand coming in, 9 grand going out, so that's cash flow positive, and I owe $2 million on my house. That's not going to work. Bankruptcy will, though. But this strategy, nor is a mortgage going to work. You should talk to a bankruptcy attorney. I'm only kidding here. But so it's dependent on your debt load. Now, it's also, because some people say, oh, this is only for those making 6 figures. That's not the case. Because again, it's based on debt load. So let's say, I've got a newlywed couple, they're making $5 grand a month and they got $3,000 of expenses, but they owe $150. This will work, right? It's based on debt load. So somebody asked the question, debt ratio. Most banks like to see a debt ratio of 45% or below. Some will go to 55, but most like to see 45% or below. Now, the way banks stress test HELOCs is entirely different than they do on mortgages. Because again, a mortgage fixed rate payment doesn't change. So they can do a DTI based on a 30-year term. At that payment, it won't change. Where with a HELOC, they have to stress test it if it's a variable product, because the payment can change up or down. And as an underwriter, they don't care if it's going to go down. They only care if it's going to go up. So they will say, whatever the note rate is plus 2% over 20 years, that's how they'll stress test it typically to come up with that debt ratio. And I know that's a lot of in the weeds there, but we help folks with that, or we analyze that on the front end before we elect to hire them as a client.
Good, and that's something I want to hit on, guys. If you've not scheduled with Michael's team, really that's kind of the front end of going into it. It's a lot more than let's sign up for a HELOC. It's a very a process of, okay, what makes sense for your finances? What are you trying to do with it? We've got a couple questions on, for example, doing this with an investment property. So Michael, here's one. It says, I currently have a HELOC on my home for $87,000. I'm looking to use this as a down payment on my first investment property. Do you think this is the best route to stepping into investing?
Well, I mean, outside of an IBC, I think IBC is another place to store cash. And then after your IBC, then real estate. Yeah. But I mean, if you've already conquered that and you've got your sacred account, then yes, real estate is a good option as well. And here's some of the other things that we teach people is always to leverage, right? So let's say you have $100,000. Yes, you can do a HELOC on an investment property at 80%. Most banks won't touch an investment or rental property, but we know about a dozen banks that will easily lend 80% loan to value on a rental property. But let's say you have $100,000 of equity, and I'm just using easy numbers. I know the real estate market's crazy right now, but you typically like to buy $100,000 rental units, right? So you got $100,000 in equity, and you're looking to buy $100,000 rental units. I like to do pop quizzes. Pop quiz, how many units can you buy with your $100,000 worth of equity? Most people would say 1, and you would be wrong. So there's a hint. Yeah. So I already gave it away. Anybody answering? Don't say anything?
Someone says
2
10.
to 3. 5. Justin. I like Justin. Cynthia said 10. No, you're wrong. Crystal, 5. You're right. Yes. Good job, Justin. It's 5. Because again, on a rental property, you got to put 20% down. Okay. So what's 20% down of 100,000? That's 20 grand. So you chop up your 100 grand into $20,000 down payments and go get 5 properties instead of 1. Because if you have 1 property and you have a vacancy, it's a big deal. But if you have 5 properties and you have 1 vacancy, it's not a big deal. So how do you take 100 grand to turn it into $2,500 to $3,500 a month of passive income? That's how. There's a multitude of ways. We get into tax liens. We've got one. They can't call it a guarantee, but it's a fixed rate of return of 46% a year. So I get into all kinds of different things. I wouldn't call myself a gambler because I have my own IBC policies and I got my defense here. And that's essentially something that I want to talk about is replace your mortgage is a defensive move, but you can also utilize it to play offense because you can access this capital that you have in your backyard to put into your sacred account. And then from there, you can start making some offensive moves like getting into real estate or day trading or whatever that you're into and what blows your hair back.
Awesome. I love that. There's a question here. Can I use a HELOC as my company's bank account?
You got to be careful because I'm not an attorney, but I will tell you this. You can do anything you want with a HELOC. You could go to Vegas and gamble it away. You could do smart things with it. You could do dumb things with it. Yes, you could use technically. You can use it for anything. Think of it like a checking account. Would you ask that question if it was a checking account? No, because you know what you can do with a checking account. You do whatever you want. It's your money. Same thing with a home equity line of credit. You can do anything you want with it. Here's the thing that I will, use my attorney's advice is, let's say you're taking that HELOC and you're using it for the business. Well, now you're commingling funds, and you could potentially pierce the veil of your LLC and the protection that it provides for that business. There's a right way and a wrong way to do that. You could set up promissory notes where you could take your HELOC and lend it to your business, and your business has to pay your HELOC back plus an interest rate, which is a very wise thing to do. And it kind of helps protect that veil. And something were to happen in the business and the business gets sued, a good attorney is going to look where you've commingled funds and not only go after the business, but also go after you personally to try to squeeze you. So I'm not trying to scare you, but there's a wrong way and a right way to do things.
And that's a good point. So you want to make sure, like we had a call, guys, last week with Hive Law. So that's perfect. If you're working on, replace your mortgage, you've got your business, you're looking at that, I would get with Hive Law on that, get your consultation with them too. Another question from Sean, can you do this on a vacant piece of property? I owe $100K on a vacant property that's worth $500K.
Yeah, 100%. Yeah. It doesn't have to be rented out. Now they're not going to, if you don't already have a primary residence and you're not claiming that, even if it's vacant, you probably shouldn't be claiming it as your primary residence. The banks don't care if there's rental properties there or not. They're going off of your tax returns and W-2s. The qualification in process is almost identical to getting a mortgage. There are some steps that are taken out because it's not the same laws and regulations as a mortgage. So some of it is smoother than closing with a mortgage than by doing it with a HELOC. But if it's a vacant property, long-winded answer is yes, you can absolutely get financing on that.
Awesome. And then this is kind of along that line. When do you apply for a HELOC if you're doing a first-time home purchase? Is it before or during the transaction?
I'm trying to understand the question. I think what they're asking is, can they purchase a home with a HELOC? Is that essentially what you're taking?
Yeah, it sounds like it. Do you get pre-qualified, kind of like with a mortgage, or do you go pick the house first and then come say, I've got a HELOC for it?
Yes, always start with the banks. Most people get that wrong, where the first thing they do is they go get a realtor, and then they start looking and shopping for a house, and they don't have a pre-approval letter. They don't have their finances in order. Always start with the bank. Let the bank determine what you qualify for, then talk to the realtor, not the other way around. Again, that's something that was frustrating for me for 17 years as a mortgage guy. Realtor sends me a client and says, hey, I've got this $700,000 house. We're under contract, we're closing in 30 days. I need you to close on their loan. I look at them like they qualify for 500. They're not putting 200 grand down because they don't even have 200 to put down. They got 70. So why did you allow them to go under contract on a $700,000 house when they can only afford a 500? So start with the bank because they're going to dictate what your budget is as far as the house. But to kind of answer my own question is, can you purchase a home outright with a HELOC? Yes. Let's say you're a first-time home buyer and you don't have to get a HELOC after you've already owned the property. There are banks that allow you to purchase it, and at the closing table, you close on the HELOC and you don't ever have to do a mortgage. So you have minimal closing costs. You never have mortgage insurance, even if you go above 80% financing. And, obviously all the other benefits that come along with a HELOC, but you would have to put 10% down. Of the banks I know, we did have one bank that was 100% financing on purchases, and we blew their phone up and they're like, okay, we're discontinuing this. We're going down to 90% because they got too many phone calls. I'm like, well, I told you it was a good product. You're going to get a lot of phone calls. And that's the crazy thing. Again, bankers, they don't make money on this. So we literally had a banker say, please take my name off your list because I'm getting 20 phone calls a week. And I'm like, well, what's the problem with that? He's like, I get paid the same if I get one phone call versus 20. And I would rather get one. I'm like, man, the entrepreneur in me, the CEO in me, you're fired. But that's, again, bankers are salary based. They're not commission based for the most part.
Michael, on that note, I've heard you tell a story of, I don't know if this was a client that went in and the banker basically said, yeah, we do HELOCs, but I'll never set you up with one. Is that, do you have that? Can you tell us that story real quick if you've got that recollection?
Man. There's so many stories. That happens every single week. When people go rogue, there's a reason why we spend the time, the thousands of hours to create what we call the bank list, right? We build relationships with really good community banks and credit unions that got really good products that are, most HELOCs are absolutely free. You don't even have to pay for appraisal fees in some cases. So we develop these relationships for a reason, because when people come on and they get this education, like, all right, cool. Now I know what I need to do. I need to go get the right HELOC, because there's so many different kinds of HELOCs out there. A good analogy is, Jerry, you need to borrow money. You ask me and you ask your mother. Well, we're going to have two totally different terms and conditions because one trusts you more than the other, right? Same thing with banks. They have totally different HELOCs from bank A to credit union C. So we help our customers navigate that maze and determine which one's the best fit for them. But more importantly, we have a relationship with that banker there and says, hey, we've got a client. And they're like, we already know. From Replace Your Mortgage, we know the questions they're going to ask. We know what they want set up. We got your back. So we help folks with that.
That's awesome. We've got a question on what's the timeline on doing a HELOC? Is that normal like a mortgage? Is that different?
Mm-hmm. No, it's almost the exact same process. I would allocate 45 days. Some will knock it out in 2 weeks, but those are anomalies, small credit unions that just look at it real quick and, don't have tons of files coming in and they can knock it out in 2 weeks. But I would not have that as an expectation going into it. I would have the exact same expectation as you would with a mortgage. Allow 45 days for everyone to do their processing, verify your employment, appraise the home, et cetera.
Awesome. And then this one, I think most of us know the answer to already, but can you refinance an FHA loan into a HELOC?
100%. Yes. And you should, because with an FHA loan, you not only paid upfront mortgage insurance premium. So a lot of folks think that they put 3% down when they bought their house utilizing FHA. They actually put 1.5% down, because half of what you put down went to go towards the upfront mortgage insurance premium. Not only does FHA charge that, but they also have a monthly mortgage insurance. So yes, none of that benefits you as the consumer or the borrower. It only protects the banks and the lenders. So yeah, you should refinance, and you can refinance an FHA, a VA, a USDA, Fannie, Freddie, any mortgage you can refinance at your right to do so into a HELOC.
Awesome. We've got a question here. What effect does it have to put all your income into the HELOC other than just the ability to pull cash in and out? And I think this is maybe a good example on what that does with your net effective interest rate, Michael.
Yeah. So here's what it is. This is what another thing a HELOC does that a mortgage doesn't do. I don't know if you can see that. It's called recast, right? Recasting is, let's say you put $100,000 falls from the sky and you put it towards your mortgage, right? Will it change the payment on your mortgage? The answer is no. It changes the balance, but it doesn't change the mortgage payment, nor does it really change the amortization schedule. Again, a mortgage is old French for death pledge. You sign that contract at closing saying, hey, on month 244, my payment is this, and out of that payment, the lender dictates how much is going towards principal and how much is going towards interest. Recasting is a very important feature that comes along with simple interest loans, not something that's like a mortgage, right? So what that means is, let's say you have $100,000 balance and you put 10 grand of your income into it. Tomorrow, it recasts automatically every single day for free. The interest is now calculated off of 90 versus 100, all right? Now, vice versa, you take out 5 grand to pay bills. Now your interest on that day is called per diem. Daily interest is calculated on 95,000 versus the 90, which is why we're a big fan of offset accounting, because that speeds the process up another 15 to 20%. So that's something I missed in my storytelling, is recasting is very important. There are some mortgage companies that will allow you to recast, but again, you got to be the 5 and 6 year old that asks the question why. They will allow you to do it, but they charge you hundreds of dollars to do it, and they only allow you to do it once or twice over the lifetime of that loan. Why is that a protected feature? Why don't they want you to do that? And again, most won't even do it at all, but of the ones that will, they charge you exorbitant fees and say you can only do this 1 or 2 times because it benefits you massively when it recasts. A home equity line of credit does that automatically every single day for free.
That's awesome. And guys, the math on that, if you're doing those deposits, that's paying your rates, your balance down, your actual interest cost, like on an amortized schedule. If you're looking at it from an internal cost, it's not going to be the same as your gross rate. So even if you're on a 6%, gross rate, you take your annual interest divided by that average daily balance, and it's a lot lower than 6%.
You don't even have to guess. When you close, if anybody closed post 2010, you would have gotten what's called a loan estimate, right? Instead of a good faith estimate. The HELOC still goes off of the good faith estimate. It doesn't have to abide by the Dodd-Frank regulation. But all mortgages, they have to provide you with a document called the loan estimate. On the last page of the loan estimate, at the very top, when I was talking earlier about pay attention to rate of interest, not interest rate, that was a phrase I coined before this ever came out, and it's called TIP, total interest percentage. So in your loan estimate, the government forced the lenders to disclose to you so that you know how much you're getting screwed, how much interest you're actually paying. So at the top of that page, on the last page of the loan estimate is TIP, total interest percentage. If you have a 6% mortgage, your TIP is probably going to be north of 75%. What does 75% means? That's how much interest you're actually paying to borrow those funds. Not 6%, 75%. So here's what a mortgage does. Banks don't like to be in physical real estate, but they like to be in monetary real estate. So what that means is you buy a home, you first buy the bank their house. Then you start paying off your house. So you're really buying two homes. This is where Australians, South Africans, and some Europeans, when they're buying real estate, they look at it through the lens of how much does this home actually cost when I account for financing. So if it's a $300,000 home, and I'm like, well, it's really going to be $500,000 because of financing. Now, an Australian or a South African's like, that home's not worth $500,000. I don't know if it's ever going to be worth $500,000. That's a bad choice. I'm not buying it. However, Americans, and I'm not saying this group, but most Americans, 99% of us, we look at it as, what can we cram inside of our monthly budget? Well, that house is $500,000, including financing, but the payment's only $2,500, and I can fit that inside my budget. So I'm going to buy it. And then that's how we get screwed. And that's how we buy one home for a bank and one home for us. Where another fun fact, Australians, I can't make a living in Australia teaching what I teach. They learn this in high school. Australians pay two homes off because they have the highest rate of second home ownership, right? They pay two homes off an average of 14 years, not one home. They pay off their primary residence and their vacation home in an average of 14 years. What do you think the average is for the American? Would you think 20 year, 25, 30? It's not even 30. Why? Because what did we do during the pandemic when rates plummeted? We took our 5% mortgage that we had, that we've been paying on for 7 years, and we had 23 years left, and then we refinanced it to this 3% mortgage rate back to 30 years. Did we actually save money? The answer is no. We actually cost ourselves dozens of thousands of dollars by going backwards and starting the amortization schedule all over again. But as Americans, what are we focused on? What we cram in our monthly budget. So that 3% lowered our payment, but it didn't reduce the amount of interest you're paying.
Amazing. And then we've got a question here. What's the criteria difference between a primary residence HELOC or a rental property?
The down payment. If you're purchasing or if you're refinancing, primary residence, 10%. You can do 90% financing all day long on a primary residence. On a vacation home or a rental property, it's 80% financing.
Got it. And then how do you account for property taxes if you have a HELOC?
You pay it yourself, and you should. Because think about what a mortgage company is doing. They don't actually make money on this. So that was one thing that folks thought is, well, you're making me escrow because you make money off of these dollars. By nature and by law, you can't make money on an escrow account. But what they're doing is they're holding on to your funds. They're not paying your homeowner's insurance and your property taxes every single month. They're only paying your property taxes when they're due. They're hanging on to your funds because they don't trust you to pay it. Because if you don't pay your homeowner's insurance and there's a fire and the house burns down, nobody pays off the mortgage lender, right? Well, if you don't pay your property taxes, well, guess who gets first lien rights? The government always gets first lien rights. They got to get their money first. So they're going to put a lien on the home and put the lender behind them. So they like to hold on to your money and pay it on your behalf because they don't trust you. It's actually not wise money. You shouldn't escrow, because if you know that every dollar is benefiting you when it's sitting in the home equity line of credit, then don't pay things on a monthly basis. Pay them when they're due. So for instance, here in Tennessee in Williamson County, I get the tax bill in October. It's not actually late until February 28th. So I've got 6 days. I still haven't paid it. I'm going to send them, or I'm going to pay online on the 28th because the money's sitting in my home equity line of credit. Same thing with tax refunds, right? Some people pound their chest like, oh yeah, this year I'm getting a $12,000 tax refund. This is where there's a relation here between escrowing your property taxes and homeowners insurance and getting a tax refund. And I know that sounds strange, but I'm going to explain it to you. Getting a tax refund is a horrible mismanagement of funds. What that means is you've overpaid your taxes all year long and donated it to the IRS for them to do whatever they want with it for 16 months. And then when it's time to give it back to you because you overpaid, they give it back to you at no interest. Now, how many people do you know that you would give them thousands of dollars for them to hang on to your money for 16 months and then for them to give it back to you at no interest? Not none. Okay, so don't do that with the IRS specifically. So getting a tax refund is a terrible mismanagement of funds. Adjust that, because now the $12,000 could be sitting in your home equity line of credit, suppressing the balance, reducing that much more interest over the course of the year, or invested for you to get you better than a 0% rate of return.
I love it. So guys, we're going to probably wrap things up here. We stayed on a bit more than an hour. I want to thank Michael for his time. And just really quick, again, guys, if you've not scheduled with the Replace Your Mortgage team, definitely take the chance to do that now. You know, I have this saying that I like to say is knowledge. You know, we talk about knowledge is power, right? It's not a power if we don't apply it. And so if we're on something like this, we're learning, we're getting information, that's great. But it's a lot like eating calories and then never going to the gym. We become, intellectually obese, if you want to call it that. So I want to encourage you, get in the gym, schedule a call, get an appointment set up with Michael's team, ask your questions. They have a great ebook too. Like if you're interested in getting more info before that call, let us know. We can get you access to the ebook as well. So you can use the QR code. You can go to rym.wealthdynamics.com. Michael, do you have anything you want to wrap up with? Any final words before we close out tonight?
Yeah, procrastination and limiting beliefs is what really holds a lot of people back. We're not here to sell a widget. We're here to help people grow and help people become successful. That's how I grow my business. That's how Jerry grows his business. We could not continue to get new clients if we didn't help the previous clients get to success. And procrastination and limiting beliefs is what keeps people in their stagnant situation. So all we're asking is just to have a conversation with you, and it's absolutely free. We just want to look and see if this makes sense for you, because there's going to be some people that will book a call that we will give you the straightforward answer, not at this time, but we will give you homework and say, here's what you need to fix. Here's what needs to happen in order for this to make sense for you to come back to us 6 or 8 months from now. So every phone call, people leave with value. So yeah, don't procrastinate on this, because it's something that I kept inside and bottled because I was the recovering mortgage banker for years. And man, I wish I'd have started this back in 2009 when I heard about it instead of 2012. I wasted 3 years, and 3 years may not seem like a whole lot, but I paid off a $400,000 home in 3 years. Imagine what an extra $400,000 in 2012 would look like now in 2023 if you understand compounding interest. It's massive. So don't delay. I sound like an infomercial. Don't delay.
Thank you so much, Michael. Well, guys, we'll definitely send out the replay. Email me if you'd like the ebook. If you didn't schedule, do that now. That's rym.wealthdynamics.com. Michael, thank you, man. It's been a pleasure. I just love your message, the service you guys have, the help you provide for our clients.
Awesome. Thanks, Jerry. Thanks for having me. Y'all take care. God bless.
Have a good night.